Welcome back to the journey to true wealth. Well, today as we sit here, it's April 3rd, and the market's down about 1,500 points. That equates to about 3.5%. And the Nasdaq's down even a little bit more than that. So if you're concerned, maybe you have a right to be. I've already received a couple emails of people that were concerned. No phone calls yet, but I thought it'd be good to address some topics that we've been talking to clients about very frequently, and really a concept that I think is very important. I'm going to ask Dana to pull up a chart as I'm talking, because I want to go through what we've seen over the last 20 years or so. We've actually had several, and you've probably forgotten some of them, several bear markets. Going all the way back to 2008, of course we remember that. The market was down 57%. Do you remember the government shutdown in 2011? Also, do you remember how choppy the markets were in 2016? How about that Santa Claus crash where the market went down close to 20% in 1 month, right at the end of the year? I think that was 2018. Then we had COVID in 2020. The market dropped 33% or 34% in 33 days. And then we had high inflation that drove the markets down in 2022, just a couple years ago. And here we are today, the market's down a little over 10% year to date, coming off of a couple really good years. So what do we do about that? Because as I always hear, this time is different. But is it? Because with history as our guide, I think we'll find out that the names of all these things are different. So the way that these markets start is always frequently different, but the way that they end is frequently the same. Let me show you a graphic that I've been sharing with a lot of our clients, and I think it'll help bring a lot of comfort and a little confidence to how we do our planning for you. First of all, I'm going to take this simple chart, and we're going to draw this matrix two different ways. We're going to look at the level of importance. How important is something? So here it's very important. Here it's fairly unimportant. And then also we're going to talk about how knowable is a topic. Forgive my bad handwriting. But if it's something that's very knowable, it's up here. If it's something that's virtually unknowable, it's down here. So why do I do this? I think it's very important that we talk about the proper things. So in this box, we have things that are both unimportant and also virtually unknowable. Well, if it's unimportant and we can't find it out, it's unknowable. Let's just forget about it. It's not worth talking about. And what are things that are very knowable but possibly unimportant? You're going to know all these things. These are things that you hear all the time. They're things like non-farm payrolls are up 2.3%. The Fed just released its new beige book for April 1st, showing the economy was adjusted down from 2.8 GDP to 2.7. How about this one? University of Michigan's Consumer Sentiment Index is up at 87 as a marker. These are all things that are perfectly knowable. We can measure them. We have a lot of smart people out there that track these things. I will profess to you that they are completely unimportant. And what's something that's possibly very important, but also unknowable? Well, this happened a lot. And the proof of this happened a lot at the end of 2022. It sounded something like, we think the market's going to be up 13% at the end of the year. Or we think the market's going to go down. Or we predict a recession. Do you realize that Bloomberg, JP Morgan, Morgan Stanley, all predicted recessions in 2023? Of course, we had a great year. Fortunately, we didn't listen to them. So in this box of things that would be very important to know, but they're actually completely unknowable, is just predictions. It's virtually impossible to get these predictions right consistently, so we don't try. Now let's talk about what's very important and also very knowable. I profess this is the box we need to spend our time on. Things that are very important and also very knowable are things like you need $10,000 a month to live on. We know you have to pay for a wedding in 3 years. You're going to retire in 2 years. The 401k plan you have has a 4% match, and we should participate in it. We know your tax liability is $10,000 a quarter, and we have to come up with a funding plan for that. So the things that we need to focus on are these planning topics, not predictions, not all these facts. And I know the market's down today because of tariff fears. And I'm also going to put up a graphic that shows what tariff actions were taking during Trump's first term, how it affected the markets, and maybe also how it affected interest rates. I think you'll find that chart very interesting as well. We're always here. When times are tough, that's when you should rely on us the most. What I did find that was very interesting, in all those bear markets that were looked at previously, in every single one, the way that we structure bucket 1, which is years 1 through 3, it would have made it through the entirety of all those bear markets without even tapping into any other assets. So all this volatility we're seeing, it's all happening in bucket 3. We have 3 buckets in all of our investment portfolios. We have 1 through 3 years, which is safe money. We have years 4 through 7, which is an intermediate term. And all the money that's geared for growth, that's money we've determined you don't need for at least a decade, that's where all this volatility is happening. So when clients come to me concerned, my one question that I like to ask them is, which bucket are we talking about? Now, if you have further questions, or you want to learn more about this, or you liked what you saw, please share it with a friend. But I hope it gives you a little bit of peace of mind. Hope you realize we're not asleep at the wheel. We're very much actively looking at this. And we have made a few tweaks around the fringes as time goes on to portfolios. So if you need to talk, give us a call. But I'd like to talk about your planning, not predictions, and not market statistics. Have an awesome day.